All right, folks, we'll go ahead and get started. All right, thank you everyone for joining us. My name is Jeff Foley with Paladin Financial, and we've got a great presentation here for you. I have a special guest here, Bryan with Gradient Investments, who is the portfolio manager that we utilize to manage our clients' assets. And today's show, or today's webinar, we're going to talk about a quick market update. So this is part of our quarterly educational webinar series. And there's a lot going on in the market this year, as there was last year. So we want to give a quick update on what's going on out there, what's driving the market, what are some of the questions that are on everyone's mind. And Jeremy knows this inside and out. So we've got a lot we'll cover over here in a little bit. And by the way, if you have questions that you want to send into the questions box, you can do that. We'll try to take a few of those as we go along throughout the presentation. And a quick overview for those of you that are not familiar with Paladin Financial, because I see a number of our clients on here, but also a number of guests as well, is high level what we do for our clients. We have a 5-step process of success that you see here on the left that we go through, and all of our clients have what is called the Paladin plan. And everyone's plan is unique to their situation, whether you're saving for retirement, transitioning, or you're in retirement and enjoying that. We want to make sure we have a well thought out plan that addresses a variety of different issues for you and your family. So in the center of the circle that you see here, everything is focused around you and your goals. Around the outside of the circle, those are the areas that we address as part of our planning process. And we're not going to go through all of those right now, but we have comprehensive plans for our clients. And we have intentionally last year is the investment management piece of this. We want to make sure that the assets you've worked your life to build up, we want to make sure that those are appropriately invested based on your situation, your risk tolerance, your income needs, and what's going on in the world around us in the market. And that's where we partner with Gradient Investments as a portfolio manager to help do the day-to-day management of our clients' assets so that we can focus on financial planning and helping you to make decisions that are going to be beneficial for you and your family throughout retirement. So a lot of different areas that we address through that process we won't get into here today. If I was to simplify that diagram a little bit further as it relates to your adulting life and the things that we help folks with, you have your financial plan, you have your estate plan, and you have your taxes. We want to make sure all of those areas are working together and you're not walking in 3 different directions with your plan. So the financial side of it, if I was to break that down further, the investments that you are invested in are an important piece of that pie, but it is not everything. We want to make sure all this is integrated together. One of the things we do as well for our clients, we have a couple of events each year that are face-to-face educational events, and this is for clients only. We have an educational event coming up on May 9th in the evening. That's actually will be downstairs in our conference facilities, and this is an educational event about estate planning specifically. So one of the estate planning attorneys that works with a lot of our clients, Matt Tram Law, is going to be doing the bulk of that presentation. We'll be talking as well. We're also going to sprinkle in some fun, and we have a chef that's going to talk about some summer recipes to keep on your radar, and we'll have hors d'oeuvres, drinks, and all that fun stuff. So if you're interested in that, the QR code on the screen there, you can hold your phone up and register for that, or give us a call in our office. I'll also show that QR code here again towards the end of the presentation. So we'd love to have you if you have gaps in your estate plan. Again, going back to that pie that we talked about, that's an important component. We want to make sure it's addressed for you. Whether or not you decide to use that attorney or not is irrelevant. So switching gears, I mentioned Bryan is a portfolio manager with Gradient Investments, and we see each other in the hall every day. So Gradient manages our clients' assets, and they have around $5 billion of assets, depending on the day in the market, and help people throughout the country. And Jeremy manages a number of the portfolios within Gradient Investments, and you might see his beautiful mug on Fox Business, CNBC, places like that, doing market updates and commentary about different things that are going around in the world. So thank you, Jeremy, for joining us here this afternoon.
You are very welcome, sir. Thank you for having me.
Yes.
From my perspective here today, I just want to take a step back and, well, one, thank Jeff for having me, but two, what he talked about before is absolutely important with regard to this being a component of your overall plan, is that what we're going to talk about today is important, but it doesn't usually change aggressively what I say from client allocations, because Jeff and people that we work with have done that homework for you and the clients to understand your overall situation. This is just another piece of that puzzle. And so what my job here is today is to kind of walk you through just what we're paying attention to and the things we're looking at with regard to the markets. Now, does this mean we're going to sell or buy aggressively based upon that? What I always tell you, it depends on your situation. So none of this is ever set in stone. But with that said, let's get started on it. So Jeff, you want me to run it here?
Yeah.
All right, look at that. I get to do it. All right. Sweet. So here's what, so this is year to date. And the biggest thing that I always take away from this is that we've had almost a complete flip-flop, right? Is that the only thing that worked last year with regard to performance was commodities. And stocks were down, bonds were down. That was the one that probably shocked people the most, right? Is, wait, my bond portfolio can be down 13%? Well, yeah, last year it certainly can. So that was a difficult spot. Now this year we've had a complete reversal of that. We've come out of the gate strong. This is as of March 31st, but stocks are up, large cap stocks, the S&P 500 is up about almost 8% so far. And it's actually a little bit higher at this point now. International stocks have worked well so far this year. And then also bonds are now chipping in and giving you some income and actually some performance this year. And so what's not working? Well, the thing that worked last year is that the one asset that's actually declining because we're starting to see inflation coming down. Commodities kind of roll with inflation. Just think about it that way. If inflation is rising, commodities generally work. When inflation is starting to come down or turn the other way, commodities don't work as well. So that's why you've seen the flip-flop of that asset class. But overall, we're having a pretty strong year.
So one of the things that stands out between these 2 years, and one of the messages that we talk a lot about, and I think you do as well, is we can't necessarily predict with a lot of certainty what's going to do well in a given period of time. What we can predict is that being diversified, staying invested, letting things work themselves out over time generally turns out pretty darn good. Is that a fair statement?
Absolutely. We say something that's absolutely hokey, but absolutely true, is that time in the market is always better than time in the market. Is that from a year-to-year basis, we never know when we're going to have 2022 events, right? When the market is going to have a very difficult time. We never know with perfect precision when that's going to happen. But think about the other side of that coin, is that 73% of the time over the last 100 years, the market has been positive. And so time in is actually in your favor, and the odds improve the longer you can stay with that course. But trying to figure out what's going to happen every year and setting a plan based upon year-to-year analysis is just, it's really difficult to do.
So walking that back, one of the things you said there is 73%, around that to 75%, 3 out of 4 years the market is up.
Exactly.
1 out of 4 years the market is down. And so staying with things long term, if you're appropriately invested, and risk tolerance and income needs and all that need to be factored in as well. But staying invested is really important. Absolutely.
It goes back to you saying part of the plan. This is part of that plan, and part of that plan is staying the course even when things get a little tough. You can always make incremental tweaks and make it slightly better and change it based upon what's going on, but you don't go aggressively away from the plan unless something in your life dictates that.
Good.
So let's talk about the economy a little bit here. This is the jobs number, and this is the one thing I will tell everyone, is that this is really holding up the U.S. economy at this point right now, to be honest with you, is that we're still at near 50-year lows in the unemployment rate. So pretty much still at this point, despite what you're hearing with regard to Google laying people off and Microsoft laying people off, the job market is still really strong at this point right now. Now, what does that look like in a year? We think it actually probably starts to look a little worse. And the reason we say that is because, honestly, the Federal Reserve is trying to do that, right? They're trying to slow the economy. So when the economy starts to slow, we start to get some job loss. Now, what we don't see, though, is certainly not the COVID level of job loss, right? That was basically the largest in history. That's that huge blip upward in this chart. We don't even think it gets back to that 2008-ish level. We really think that you got to think about what employers have gone through, is that post-COVID, from the recovery, they were having to close a restaurant because they couldn't staff their people, right? And those kinds of things stick with you in mental. So from that perspective, they're not going to really want to fire people really quickly unless something gets really massively deteriorating in their business, because they don't want to go back under that assumption of, I can't stay open because I don't have the staff my business. So we really think that while this number could go up, we don't see it accelerating aggressively because, frankly, we don't see a large scale of contraction in the economy coming forth. We could have some slowing and maybe even fall into recession, which I'll talk about here in a bit. We get maybe there, but I don't think the level of job loss will be anywhere near what we've seen from these last two recessionary periods.
Okay. That's good.
From an inflation side, this was the story of 2022, right? As inflation got, to be completely honest, somewhat out of hand, and it's caused a lot of things to occur with regard to the Federal Reserve having to get aggressive. Their two mandates are full employment and inflation control. One, full employment was taken care of, inflation control got out of hand, and so therefore that's why they were raising interest rates to try to control these numbers. And our expectation is that core inflation's peaked. We think last fall was the peak of core inflation. We think that that chart is going to start normalizing. Will it get to that 2% level by the end of the year? I don't think so. I think if you were to have to ask me, I would say we'll probably stay above that in that 3-ish, 4-ish% range by the end of the year. But that number is certainly coming down to where, as that number comes down, the Federal Reserve can say, okay, what we're doing is obviously having an impact on inflation. Maybe we can calm down on that. The fear in the markets is that they won't calm down on it, cause this to come down, but also cause economic growth to come down as well and cause that recession.
What do you typically see as the lag between the Fed increasing interest rates and the impact on inflation, and when they know whether or not they nailed it or not?
Yeah, it's a great question because it's not perfect, but think about 6 to 9 months. You know, they have to do things that far in advance. And so they got caught a little shorthanded on the other side. I don't think they thought it was going to get as bad as it did. And so they didn't really take action right away. And so they had to step up their level of aggression to kind of start to combat that. Now, the question is, knowing that that won't take effect until 6 to 8 months from now, are they going to calm down from that perspective? And we'll just have to kind of wait and see what they say. You're still seeing the commentary from the Fed governors and saying, we have to get this under control. We can't let this be persistent. They have to continue on that commentary because the minute they stop, people are going to say, oh, well, they're done and all that stuff. So they have to keep on the commentary, but we're going to pay a lot more attention to what their actions actually are.
So there's a sweet spot in there where some inflation is good, a lot of inflation is bad. Why is a little bit of inflation a good thing for the economy?
Yeah, because it shows economic growth. Because as you're getting jobs, your wages are growing and those kinds of things. And as your wages grow, the U.S. consumer does one thing better than anyone else in the world: they spend money, right? So they're going to spend money on things, and if they're getting more money in their pocket, they're going to spend more, which causes demand to rise, which then causes price to rise. That's absolutely healthy. What you don't want is to get it out of hand, because then, from the high side, because then people don't know, obviously it gets the things you have to spend on, allows you to not spend on things you want to spend on. And that's really where we make our money here, is the things people want to spend on. Gas and food, yes, Pepsi will earn a lot from food price growth, right? But at the end of the day, that if you can't buy, if you're only buying one set of toilet paper, right, you can't buy other things. And so that's what we have to be careful about here. And so that's why you want it to be, you want inflationary growth, but you want it controlled, steady, that kind of thing, so that you're showing economic growth without getting overheated.
Yeah. I was watching a show a couple nights ago, and it was based in 2013, and someone was pumping up gas, and it showed the price of gas on the sign. It's the same as we're paying now, and that's in alignment with that. I just noticed your chart here as far as gas price.
Because I usually get the other one. I was watching this show and gas was like 98 cents. I was like, yeah, we're probably going back there. But yeah, the same price. I mean, yeah, you can see that number's come down aggressively. And these numbers, food and gas, aren't actually in core inflation data, but we pay a lot of attention to it because that affects consumers' pocketbooks. And really, we think that's the lifeblood of the U.S. economy, is whether the consumer can continue to spend.
Good.
So this is a good one. This is banking issues. And, if you've been following the news over the last month and a half especially, you've seen that we had 2 U.S. banks actually were forced to shut down. That was Silicon Valley Bank and Signature Bank. A lot of times what I always tell people is, if somebody says it better, I'm just going to steal it. And I did in this round, is that, RBC says a crisis for a few banks is not a banking crisis. And we absolutely believe that those were unique circumstances from Silicon Valley and Signature. in the effect of what they did is they had a concentrated customer base. Silicon Valley concentrated on Silicon Valley companies, right? The tech companies. Signature Bank was concentrated on the cryptocurrency industry. When those happened and those started to need capital and they got a little concerned that their bank wasn't going to be able to satisfy that, the amount of deposits just flushed out of those institutions and they got spread out. And they were taking excessive risks with regard to their own balance sheets that caused them to not be able to meet those needs. That's what happened with those banks. But anytime you have a US bank shut down, you should be concerned, right? Because those should be veritable institutions. The nice part about it was all depositors were fully protected during those periods of time, even the ones that were above 250,000. That's the FDIC deposit insurance level, that's the maximum level. Even the depositors above that were made whole from that perspective. So nobody lost money as a result of these banks shutting down, with the exception of the people who own the stocks, right? Now I get asked a lot of questions. Well, is this bank run systemic? Are we going to relive 2008 again? In my opinion, absolutely not. It's a very different situation from what caused these banks to collapse versus what was happening in 2008. In 2008, there was excessive risk across the board. It was somewhat unregulated with regard to mortgages and all the things that were happening there. These were two isolated incidents that, frankly, the depositors from those institutions went to other banks, the JP Morgans, the Goldman Sachs, or not the Goldman Sachs, but the JP Morgans, the Wells Fargos of the world. Their deposits actually started going up because people see the relative safety of those larger institutions going forward. So we don't see this as massively systemic, but it doesn't mean this was a non-event, right? Is because usually what this caused is in March, we had a lot of interest rate volatility. When this started to go down, what we saw is interest rates going from 3% to 5% to 4% to 3%. That just doesn't happen very often, especially 2-year treasuries, which are basically very safe instruments. We just started to see a lot of interest rate volatility because nobody knew what was happening with the depositor bases. That's starting to calm down a little bit now. But what is happening in the future is how does this impact Fed policy? From our perspective too, what does this do for the lender's ability to be able to loan money? So that's what a bank doesn't do, right? They take our deposits, they lend it out, and that's how they make money. Right? That's what we want them to be doing too. But if they're saying, I don't know what these deposits are going to look like, well, I can't lend to the institutions that I used to in the past, that's bad for the U.S. economy. So we're going to monitor that. They've just gone through their earnings for the most part. Unfortunately, it all happened right at the end of the quarter, so they're kind of reporting numbers that really weren't affected by it yet. But in commentary, they've kind of said, hey, things are starting to normalize again. Yes, we have to take a look at our portfolios overall, but there's nothing from our perspective and what we saw in their earnings reports that suggested massive calamity.
So there was a lot of movement very quickly, more from bigger companies that had a lot of assets within banks. They flooded from the smaller, the regional banks into the bigger name brand banks very quickly. But average investor, average consumer wasn't making that move as much.
No,
they're under the FDIC limits.
That, and they were just, they're not as quick to move. They want to understand what's happening. Whereas, when you don't have FDIC insurance and you're above that level, you start thinking about it. Two banks collapsed. Is my bank safe? Well, I'm going to spread that around. So we saw a lot of movement there. The average retail client who has $5,000, maybe $10,000 in their bank account, we didn't see a lot. But a lot of questions and concerns, which is absolutely, during this period of time, I would be asking those same questions. So completely understandable, but not a situation where we think any depositor money is at risk at this point. Here's the big one. We get asked this all the time. What do we think about a recession? And here's my blunt answer, is that I think a recession is entirely possible in the next 12 months. But here's the thing, so does everyone else. This is the most widely anticipated recession we've ever had, right? Is that, going back to December of 2022, over 70% of economists thought we were going to have a recession. Now we're back at 65%. So a lot of people think we're already going to have a recession. So what I always say, go ahead, Jeff.
I was going to say, what exactly is a recession? What when people say recession, what are they?
Yeah, general rule of thumb, which we actually had this in post-COVID, was 2 quarters of GDP decline, right? That's generally rule of thumb recession. Now, were we in a recession during that time? Absolutely not. whenever you have 3.5% unemployment, it's tough for me to say there's recession. But that's generally what people think about, is that GDP or economic growth is contracting. That's all really a recession means. And how long and how deep we go into that contraction is usually the bigger question. Now, we think, again, our expectations are it's entirely possible, but it's not a predetermined nature that we're going to have a recession. We think a flattish estimate of growth this year is absolutely possible, and then a reacceleration in 2024. But even if we have a short and shallow recession where they actually call it a recession, as long as the job loss doesn't get aggressive, which we talked about before, I think we're going to be okay. From our perspective, September of 2022, you had a 25 or 27% correction in the markets. The average correction during a recessionary time is 30%. So we've already experienced almost all of that from that perspective. So the other question is once you're in a recession, once they actually call it, the market's already looking ahead to the next growth phase of the market. So whether we've experienced the recession, a slight recession in the next few months, I think the market's already thought process through that. Again, the odds are highly in favor of the economists that look to predict this stuff are saying, yeah, we're probably going to have one. So as long as we keep that short and shallow, we've already kind of prepared ourselves for it.
So recession relates to the growth or lack of growth in the economy, or declining versus the market is the valuation of stocks, and those can be a very high correlation, but you could have a recession and positive market growth depending on the period.
In almost all instances, by the time they call the recession, the market is well in advance of that, because again, the market tries to look forward. And so we've been and that's why in September of 2022, we had that significant correction, because it was saying, well, the Federal Reserve is probably going to push us into a recession. We're going to have a correction as a result of that. Now we're starting to look through that data. What could happen for that secondary wave of correction, if you will, is if the recession's worse than we anticipate. And that's what we're going to pay a lot of attention to. Whether we go into one or not isn't as big a concern for us. Is if we go into one, how fast can we get? That's the bigger issue.
One of the questions that came in is who calculated the recession odds. This piece references Bloomberg. I know you track the institution.
JP Morgan. We have the JP Morgan Guide to the Markets that they do theirs quantitatively based upon what they're seeing from production data and all that stuff. So they're putting a probability based upon what's happening there. This is just a consensus of economists. So they gather together a bunch of economists and they say, do you think we're going to have a recession or not? And if they say yes, you go on. Exactly, yeah. So from that side, that's how this is calculated. So Bloomberg just does that on an aggregated basis. But the probability of recession from the JP Morgan one that we follow is actually probably a little bit lower. It's probably closer to a coin flip.
Okay.
So this one is kind of catches people off guard a little bit, and I like that when I do charts. It makes it kind of fun. So this in the blue bars are what you were getting for yield or income from that particular asset class in June 2021 versus what you were getting at the end of March in 2023, and that's the red. So you see, I like to use this. In 2-year Treasury, you were basically getting nothing, right? 0.25% for the Treasury. That's you weren't really getting anything, right? Well, now for that same 2-year Treasury, you're actually getting 4%. So bonds had to face a lot of pain last year. We talked about that already, but a minus 13% year in bonds last year, which just never happens. Honestly, it hadn't happened since at least the 70s and probably before. But as a result of that, now you have much higher yields. And so the Treasury rate of 4% is actually more than what you were getting from high yield bonds in June of 2021. That's insane to me, right? Is that, high yield bonds carry a pretty decent amount of risk. Now, they're not going to collapse. The default rates don't tend to be that high, but they're the riskier components of the bonds. And now, owning a 2-year Treasury, you're actually getting a better yield from that than you were 18 months ago from a high yield bond. You can see, obviously, that's come across the board. Corporate bonds are paying you over 5, high yield bonds are paying you 8%.
Have you seen a switch in investors moving from high yield to safer bonds over the past year as interest rates have increased, or is that mixture stay the same?
No, we have seen that, and actually we have conducted that ourselves to a certain extent. Is that what we always say is only take the risk you need to take, right? And so from our perspective, when we can get 4 and 5% from treasury bonds, we don't really need to take that excessive amount of risk because, let's say we do have a worse economy than we expect. Well, the first thing that they're going to sell in this group is the high yield bonds. And so you'd have a really difficult bond environment to where those are sold off. What are they going to flock into? They're going to flock into treasuries. And so we own more treasuries now than we used to in the past because our analysis was just saying, hey, I can get 4 or 5% from it. That's absolutely fine from what I promised my investors on the bond side, and I don't have to take a lot of risk to get there. Now, if we start to see this become opportunistic to where things, people are expecting the worst and pricing it as such, and we say we could take an opportunity to get some added increased value, we'll do that. But right now, there's no reason for us to do so. So I think investors have done it, but I think that's absolutely valid that we've done it somewhat ourselves. Okay. Oh, this one's noisy, but I kind of like it from a perspective of just showing how volatile the market of bonds has been. Because again, what we've said over longer periods of time, use bonds for two things, right? It's income generation, and then to lower the volatility compared to the stock market, right? You don't want to take that level of volatility in your bond portfolio. Well, we've been experiencing that a little bit this year. Is that again going back to the late 2022 with regard to recession, no recession, and then into the banking issues. We've just had a really extraordinarily volatile bond market. We haven't seen it since 2008, frankly.
You touched on interest rates going up and down here.
Exactly. I mean, that's exactly what this reflects, is that how do fixed income assets move, and they move based upon interest rates. So when interest rates are moving aggressively, this will move aggressively as well. And so we're back to levels we haven't seen since 2008, 2009. What I will tell people is that though the volatility is much higher, the economic conditions are way different than they were in 2008, 2009. We're much healthier now than we were the last time they were this volatile. But you do have to expect that this, and at some point this will calm down again, but we don't know exactly when that'll happen. But if you feel like you're seeing rates move and you have no idea why mortgage rates are all of a sudden 7%, then 5%, then 6%, and then 7%, this is part of the reason why, is that all flows off the same kind of interest rate volatility. And as a result of that, once that calms down, it'll get more normalized, but we're not living in that time right now. Earnings growth. If you've ever listened to me, know this one thing, is that over longer periods of time, we believe that the market tends to follow what corporate earnings looks like. Now, is it on a year-to-year basis exactly true? No. But over longer periods of time, they tend to correlate very highly. As you're getting earnings growth, the markets usually follow suit. And so last year was a predominant example of when that cannot happen, right? Is that we actually grew earnings last year. We were relatively healthy last year, but the market was down in anticipation of what this year was going to hold, which is basically a flat year. And so we had that correction that came as a result of that. We think flat is probably this year, that as economic growth slows and those kinds of things, companies will have to pull back and they're not going to get as much revenue as they had before, probably closer to a flat earnings year this year. But what we're starting to pay attention to and what we've been telling people is that if we live through a flat earnings year this year, that's absolutely fine if we can accelerate into 2024. Because as I said before, the market will look forward, right? So as you get into the second half of the year, if 12% 2024 growth is actually anywhere near accurate, the market will start anticipating that in the second half of the year. They'll say, oh, well, we're living in kind of recessionary or close to recessionary conditions right now, but things are looking a little bit better. Companies are getting more positive. We could start to see the market react as a result.
And when you say earnings, what do you mean by that?
Yeah, so it's basically the earnings that the companies in the S&P 500 as an aggregate get. So their profitability after revenue and after all their expenses and after they pay the tax man, what do they have left? That is corporate earnings. And those are the things that really drive the market over time. Is how are our companies doing? This is the measurement of how our companies are doing in the S&P 500, which is among our top 500 companies in the world.
Good. Valuation.
So what are we paying? That's really what this tells us. And really what it tells us right now is we're paying about average. It's not, market's not cheap. Wouldn't stretch to say that. We're certainly not back to those 2013 levels of very cheap markets, but we're certainly not at the frothy levels we saw in late 2020 and into 2021. Is that valuation right now is kind of middle of the road. So that's okay. It can absolutely stay there. What I always tell people with regard to valuation is in the short term, it matters almost nothing. Like 6 months to 12 months, it doesn't really matter because the market can always get cheaper, it can always get more expensive. That's very difficult thing to predict. What I tell people is over a longer period of time, 5 and 10 years, what you pay for something matters a lot. And so you want to be, you know, when you hit those frothy points up there that we saw in late 2020 and 2021, that's probably a time to start taking some risk, you know, reducing risk a little bit. And in certain areas, when markets get really cheap over longer periods of time, generally you benefit from that. We're in the middle ground. So it's not telling us, frankly, it's not telling us a lot about what market directions are going to look like in the next, even certainly in the next 6 to 12 months, and even 3 to 5 years, it looks about average, which average, if that's 8 to 9%, it's not too bad.
So that the PE ratio, price to earnings ratio, is a measure of the valuation of the companies, and when that gets really high, you know, the term, the market's overpriced, or
Exactly.
that's low, it's underpriced. So in that period of time, that blue line up there, the market was overpriced and it's leveled back down to more reasonable range. That blue line, the dotted line, is a 10-year average for PE.
And the funny thing is, you know, when it gets to be those overpriced areas, you know, it tends to be the market's working very well, and so people are hesitant to pull out of that, right? And saying, I'm up 35%, and Tesla's working phenomenally, and I'm a genius because look at all these companies are going straight up, and that's what happens. It kind of catches onto itself. And you never know when that party's going to absolutely end, but it does at some point. So what I always tell people is that's not a signal to say I need to sell everything, but it's probably a signal to saying I'm probably not going to expect, you know, the growth certainly I was getting going forward, and maybe looking to diversify my investments even more, maybe take a little risk off the table until it gets to more rational levels, which again, we're at rational levels right now. It's not screaming cheap, but it's certainly not very expensive.
Good.
So what does this all tell me then? Is what's our market outlook? Is that, hey, bonds are going to be, there's income now, which we saw before. Again, you're getting now from 4% from the 2-year treasury. That's not bad. It's going to be, the income's going to be there, but expect that volatility to kind of continue for a little while longer until we get a better signal that the Federal Reserve is pivoting towards more of that stabilization rather than increasing those rates. We're going to be anticipating a lot. So the markets are going to fluctuate based upon it. But that's not a whole lot to worry about. We think it's much more closer to the end. Whether the Federal Reserve does 1 more or 2 more movements, we don't know. But we think they're closer to the end than the beginning. Now, does that mean they're going to start cutting rates immediately? No, it just means that we're closer to a pause territory at this point going forward. So we think the income that you're receiving from bonds right now is pretty good. Probably won't get significantly better from this area, but we can still, again, if you're getting 4 to 6% from your bond portfolio, that's not too bad. On the stocks, again, banks are the biggest thing that we're probably paying attention to right now with regard to their go forward lending. Like I said, this earnings report was based upon January to March. Well, the real issues didn't hit until the end of March. The quarters were kind of done. Now we want to see what their lending standards look like. Are they still loaning that money out? Because that's the lifeblood of growing businesses, right? Is lending to pursue business opportunities down the road. We want to make sure that they're able to do so. Again, even if we have a recession, we may have already seen the market bottom. Could we absolutely correct 10% from here? Yes, it happens. 5 to 10% corrections happen all the time. Our estimation right now is if we saw 5 and even especially a 10% correction, we'd be looking at that as an opportunity to get more aggressive because we think the longer term is actually going to be pretty positive.
Are you saying buy low and sell high?
Exactly. It's amazing how that gets blended down pretty easily. But really what we are saying is at the bottom too is blend your safety with your growth right now. Is that you don't need to be completely in either camp, right? You want to have some safety there. You want to have a backstop provision in case this recession gets worse than we anticipate, corporate earnings gets worse, and we have a secondary correction in the markets. It's absolutely possible. We don't see it as our base case, but it's possible. But you also want to be there and be invested in the things that are going to grow over longer periods of time that incorporate with your investment plan. So that bottom line is, I do it for all of them, is stay diversified, but stay invested. Is that when you're diversified, you're always having to forgive yourself for something, right? Because you didn't pick exactly the right thing, but you're never going to pick the thing at all times. So don't try to do it, stay diversified, stay through the thick and thin, you'll probably get what you need.
And that blend, that's at the heart of what anyone should be doing in their financial plan and how they're invested is taking an appropriate amount of risk relative to what you're comfortable with, and as you touched on earlier, what you need to do, what you need to make happen within your portfolio. And this changes too as you approach retirement and you move into retirement. If you have safer things in place, you can take income from those when the stock market's down, and when the market's up, pivot to take out more aggressive things. So you want to maintain a good blend of that over time as things change. Go back to, we talked earlier, you got the chart that showed the bond, different segments of the market over the last year versus this year.
Yep.
Bonds were down in the U.S. market a little over 13% last year as interest rates were increasing. Will you just touch on a little bit of that, that correlation between interest rate changes and bonds? Why are we seeing bonds go down in value when the interest rates that they're paying is increasing?
Yeah, the simple way to think about it is that inverse relationship, right? Is if interest rates are rising, bond prices are. It's generally math on how that works. Why that works is much more along the lines of, okay, just think about somebody issues a bond in January at a 4% rate, right? And then in June, now they're issuing a bond at a 7% rate, new bond here. Right. Well, am I going to pay the same amount that I was paying for that 4% if I can get a new one for 7%? No, you're going to have to give me a deal, right? You're going to have to give me a discount on that 4%. And that's why prices go down when rates go up, is that new issuance comes out at higher rates, so you got to discount the stuff you already have. That's really how that works, and it works both ways, right? Is now that 7, let's say the next one is at 2. Well, I'm not going to give you my 7 for the same price I'm getting a 2 on. You're going to have to pay more for that one. So that's how that works as an inverse relationship, and that's how we think about bonds over longer periods of time. What are we getting from income is pretty much what you get from bonds, right? Is that prices fluctuate up and down, but over longer periods of time, over 90% of the return is the coupon that you get from that bond, and what you get when you first buy it. So from that perspective, that's what we're looking at, is that right now, if you were to say, what's my 10-year forecast? I'd say, well, what's the 10-year interest rate in bonds right now? It's about 4.5% from, if you blend some treasuries, some corporates, and some high yield all together, probably get about 5-6%. It's probably about right for your 10-year forecast in bonds as a result of that. Because it doesn't take into account as much differential as the stock market. Again, that's why you use bonds. I want my income, and I don't want to take that volatility of the stock market. We've had it in a short period of time. Historically, it's not. So
one of the things that we look at as well when we meet with people and evaluate what they have in place currently is that interest rate risk. If we know we're not quite done with rising interest rates, you want to be aware of what type of bonds you're holding. It doesn't mean that bonds are good or bad, but it's having the right ones, knowing where the market and interest rates are headed. Makes
a lot of sense. Yeah, especially what I see people do a lot, and the biggest issue that I've always had when I see certain portfolios is that in order, especially in times of low interest rates, they'll extend that maturity out and saying, well, if I go 20 years out, I'll never sell this thing anyway. And so in 20 years, I can, well, you're taking the pricing risk, whether or not you're selling it or not. It's going up and down, and you never know. I don't know what I'm doing 2 months from now, let alone 20 years from now. So in that regard, just understand that that creates a level of risk that maybe you're not seeing from that bond portfolio. Is that the further you go out, the more risk of that interest rate changes will have on that portfolio.
Yep.
Then this one is, I'll touch on this quickly, is, we talked about, is a 5-10% correction possible? And I say absolutely. The reason I say that is it happens every year. We've already had one this year. So from that perspective, the gray bar in this one is the amount of decline in any particular year. So even in really good years, like the red bars are the end of year performance. So you can see red bars, much more frequent up than down, right? But every year has a pretty decent sized correction. It's the rare year that only has a 3 or 5%. There's only 2 times on this chart that didn't have a 5% correction. It happens all the time, even in really good markets. I mean, I look at the 90s, is that you had a 19% correction in 1998, it was up 27% that year. And that's a very big differential. So understand that corrections happen all the time. It's part of investing in the stock market. You don't get 9% every year. Sometimes you're going to get 30, sometimes you're going to get -10, sometimes you're going to get 15. It's going to fluctuate from year to year, but over longer periods of time, that tends to smooth out to that long-term return.
Yeah, stay, as you said earlier, time in the market, but having that appropriate mixture of risk is really important.
Yeah, and increment, you never have to stay exactly where you are. You want to make incremental tweaks, but it has to be in alignment with your plan. And then secondarily, just with what the certain situation looks like. It doesn't have to be aggressive. The most aggressive movements are always going to happen as a result of life changes, right? Retirement or legacy transfer. Those are the things that create significant portfolio. These are incremental shifts based upon what we see in the market.
So, and again, good indicator. You can't predict things. If you look at that swing in any one year, it's pretty significant.
Yeah, definitely. And then the last one I'll touch on is just bull versus bear markets. Is that bear markets are painful. There's no fun in those things. Like no one likes them, and they happen really, really fast. Like you're down 30% before you can blink an eye. We just saw that in 2020, right? COVID was the fastest decline from peak to a 30% decline in history, right? It happened in a matter of 14 days, which is unreal, and it hurts and it's painful. But just remember that over longer periods of time, we're much more in bull markets that tend to extend over longer periods of time. It's the slow and steady increase that over time, that's how you'll make your money. Is that these things, you have to live through those painful times to get the fruition of the long-term trends that are actually in markets. Markets have historically, over the last 120, even 200 years, historically have always made new highs, and we think that that'll happen again. We don't know exactly when, but again, we may be at the we could have another correction here. Again, if the recession gets worse, it absolutely could happen. But we also could be at the start of a new prolonged bull market that could last 4, 5, 10 years from this point going forward. That's actually the more likely scenario than the one that we have a consistent bear market, because frankly they just don't last that long.
Yep. Good. So wrapping up, one other question I was going to mention that someone had written in was regarding gold. So gold was up the 8% this year so far, negative last year. Does that reflect an unease with banking and what's happening with the banking sector and inflation? And should we expect gold to decrease as the market confidence increases? What's kind of that correlation look like, and why has gold behaved the way that it has over the past last year and this year?
It's a great question because it's almost a two-parter. That this year, I would say banking concerns have created the ability to say, you know what, I just want to safe haven. Honestly, if you look at, and this is not a correlation at all, but Bitcoin performance has been very positive this year after an absolute disaster last year.
A little bit of a rough year.
Yeah, so don't get me wrong.
Have that on your
yeah, exactly. Don't get me wrong about how bad that was, but nonetheless, people have been looking for some other non-correlated assets. So they've kind of gone, the people that can stomach a ton of volatility are going into Bitcoin and those kinds of things, but also gold is kind of benefiting from that as well. The interesting part about that before is that gold is often looked at as an inflation hedge, but it's down last year. Now it wasn't down as much as stocks, so you could say it did protect some assets, but it was a negative year in a high inflationary environment. So there's an argument to be made that's not a perfect correlation either. What I always say about gold is this, is that it is much more of a non-correlated asset. That's what you want to have it in there for. It doesn't flow in the same direction as stocks and bonds at all times. So when stocks and bonds are having difficulty, a lot of time gold can offset some of that. But it is a very volatile asset. It's just as volatile, if not more volatile, than the stock market over longer periods of time. So it's a hard one to time and predict very well. And we've had a really substantial run here recently to where I wouldn't be a big pile into gold type of person right now. From my perspective, it's much more in having that 5 to 10% allocation to give you that correlation benefit to where, hey, if things aren't, things start to roll over, gold may hold up a little bit better, those kinds of things. But it is a really, really difficult asset to try to time on a basis because its demand and its supply tend to be much more sentiment driven than anything else, and that can change.
The kind of a professional annoyance. You're driving in your car and you hear a commercial on radio for gold, and you can't lose money, and you're going to double in 3 years. And it is a very volatile asset class. Doesn't make it a bad thing. It's just being aware of how to use that and what dose to use it and when to use it. But
yeah, it's never going to pay you a dividend. It's never going to pay you a distribution. All you get out of it is what somebody else is willing to pay you for it. And that can change, like I said, on a dime. It can go go from very positive to very negative.
How does Gradient in its portfolios build gold, silver, and other things into the mix?
Yeah, it's been a pretty consistent allocation in the endowment series. For the perfect example of how we use it is it's been about 5% in there during that period of time because we incorporate 20% into non-correlated or alternative assets in that endowment series portfolio. So we're gonna have stocks, bonds, and alternatives in there because we wanna have things that don't have perfect correlation to what's happening in the stock and bond markets. So that's how we use it in the endowment series. And then when we're building client allocations, even outside of the traditional, it's not a default allocation for us in way, shape, or form. And I always tell people if they do want to have exposure to it, just understand the volatility and probably don't want to make it a predominant source of your asset allocation, especially in retirement, where you're using those funds and you want to reduce rather than extend utility.
Plus, it's so heavy.
Yeah, and yeah,
It's very heavy.
if you smash a toe with a gold brick, you're not going to feel very good.
So kind of wrapping things up, I mentioned at the beginning a little bit about our client educational event that we have coming up on May 9th here in our building. And this is for our clients. If you're interested in registering for that event, I'll have that on the screen here for a moment. But educational event about estate planning basics, wills, trusts, powers of attorney, transfer on death deeds. Lots of fun will be had there, but we will sprinkle some other stuff in there. Jeremy, thank you very much for joining us. We'll wrap up here in a moment and talk a little bit about kind of next steps. For those of you that are not currently clients of Paladin Financial, we offer you a complimentary second opinion on your plan, on your retirement, on your investments, whatever is on your mind. And part of that second opinion is digging in deep in a lot of different areas. So you see on the screen a number of different components that we put together for you as part of that second opinion. There's no cost to that other than the time that we spend together. So if you're interested in that, give us a call. I'll have our phone number up here in a moment. We can schedule your complimentary second opinion. For those of you that are clients of ours, we really appreciate all the referrals that you send us. And as always, don't keep us a secret. So if you have friends or family that would be benefit from what we do and how we do it, please share us with them. So on the screen here, if you're interested in that complimentary second opinion, we have 2 QR codes in today's presentation. Wow. Never been done before, too.
Technologically savvy.
So the first step of that process is to complete the color money risk analysis that you see on the screen there. 11 questions, takes 4 or 5 minutes to complete that. That will give you a risk tolerance score and kind of as a starting point to opening up that process for the second opinion. And typically there are 2 meetings as part of that process. So the first meeting, we gather information, ask a lot of questions. Second meeting, we present ideas and solutions to you. No cost for either of those. If you have questions, give us a call and we can dig in further about that. We are located in Arden Hills, 2nd floor here, right down the hall from Jeremy and his team, corner of Lexington and County Road F. Highway 694 is about half a mile away, so pretty easy to get to. And again, Jeremy, thank you very much for joining us and sharing your expertise here.
You're very welcome, sir.
A lot of different topics covered there very quickly. We hope this was beneficial for everyone. And we'll also be sending out a recording to this link if you want to share that to this presentation. If you want to share that with anyone, give us a call if you have any questions, 651-842-8406. Thank you all very much and have a wonderful afternoon.